Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Wednesday, September 24th, 2025. It's 11:59 a.m. Eastern Time, so I'm starting the video, so we're about smack in the middle of the trading day. Just figured I'd do a quick one. I always say they're going to be quick, and they go for 30, 40 minutes or more, but I just want to go over a few charts that I haven't covered lately. I'll start out with usual, as I do with the equity markets. There's QQQ, very clear uptrend line, the most recent uptrend line with the little, the breakdown, the pre-Fed breakdown, back test, and then the rejection. And then just to zero in, as I often do, 60-minute charts usually gives you that more precise timing for your entries and exits on trades. This was the sell signal yesterday. We had this nice little minor uptrend line. That's the Fed. The breakdown was pre-Fed. Remember, we broke down before Fed. Had that Fed noise, I call it, back test, and then just simply extended the same divergence high. We kept below the trend line the whole time, so we remained on the sell signal, and that was the yesterday's sell signal. So nothing major at all in any way, shape, or form, although it is the biggest drop in a while, 1.4% pullback so far. And again, you have the potential targets, and my thoughts, nothing's changed, that if this level gets taken out, then that's going to increase the odds these levels, these targets will be hit. And if they're hit, as I went over yesterday, and I do quite often, it's going to change some things on the longer term charts, the daily and even the weekly and possibly the monthly charts as well. So what I mean by that, if you go down, T5's at 526, so we go back to a daily chart, you can see there that's going to take us down right about to the 200-day moving averages and these targets that I gave you back here recently on QQQ. Nothing's changed on my long-term targets. Board 8 has those targets. It's just all an extension of a big move that started really back here. Hit second target, bounced, made a marginal new and still divergent high, went down at my third target, bounced, made a marginal new and still very much divergent high. And then there's the uptrend line right there. So should the charts play out the way they indicate, we have just big multi-year divergence. And again, that's not uncommon. The big tops have usually much bigger divergence. Then there's plenty of downside left to go. But again, first things first, we are 110% in an uptrend at this point in time on the near term, intermediate, and long-term time frames. We start taking out the 200-day moving averages, as I said, then we'll look at that at the time. So again, think of it that way. These are all, every single one of these lines, these are support levels where, and I know there's some that are bullish and calling for new highs. I can certainly understand the reason for the old blow off top scenario that a lot of people are jumping on board with lately, and that doesn't matter about valuations, blah 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 blah. Maybe that happens, and if so, guys, again, you have the levels. Each of these are potential targets where a short seller could cover on a pullback trade, or a bull, somebody looking to get long or add to their longs could buy on dips. Likewise, a flexible trader can do both, short and then go long. So however you see the market, that's up to you. Again, I'm going to go over a few other charts that show you kind of, for those that may be new to the site, new to my analysis, might wonder how in God's green earth are we going to get down, if most out there, again, the vast majority, I read a lot of pundits are calling for new highs. There's no cracks in the market, solid footing, potential blow off top, which can see another 20+%. And then how are we going to drop 56%? All I can tell you, most simple form, is that like I talked about recently with the OpenAI and the NVIDIA deal, it's a circular trade. I refer to it as a circle jerk thing where, NVIDIA is supporting AI, who's bleeding OpenAI, who's bleeding cash, but then OpenAI is going to turn around for the $1 billion plus whatever NVIDIA gives them, however many billion, they're going to turn around and buy NVIDIA chips. And it's this whole thing. It's a vicious cycle. It's a positive feedback loop. And with the AI bubble, and NVIDIA I'm sorry, Apple, well, more so Amazon, Alphabet, Microsoft, Meta, the more they plow into AI, R&D, the more in their AI infrastructure, the more it benefits NVIDIA. And so, again, it's just a kind of a vicious cycle, if you will. But then when that starts going the other way, when that, whatever reason, a lot say that show me the money, when they start seeing, because it hasn't done it yet, when AI, if it doesn't start paying dividends, paying returns, return on investment on this CapEx spending, and then those big companies pare back. And they will at some point, I project. Who knows? Maybe it goes the other way for years to come. But if and when they do, then it all goes in reverse. And that whole thing can unwind. And then it is it's a positive feedback loop onto the downside, where cuts and AI spending from those big Mag 7, Mag 10, whatever you want to companies cut back. NVIDIA starts scaling back, then profits shrink, revenues go down. Somebody asked a few days ago, this is a good one, how it was, I guess, a rhetorical question more so than anything, but how these big companies, Microsoft and Meta and Amazon, how they can ever not stop making money. They make so much money. We know that. I don't think anybody out there, again, you have to understand the disconnect of how the stock market works and how these companies work. They're always going to make money. I mean, sure, they can have a negative quarter. It's possible, or year contraction. It's about valuations and cycles and the profit cycles, and also more so the valuation cycles, because there's times you can go back in time and look when, Apple here, this is a chart I've shared with you many times over the years, that it's simply, very simple. The market and stocks, they get ahead of themselves. And they do have periods of accelerating earnings growth and decelerating earnings growth. And it doesn't have to go negative. They don't have to not make money to go down. And again, I've showed you this chart. Apple has dropped 60, 70, 75, 83, 42, 62, 45. And then in more recent years, even, and again, this is one of the strong, this will go down as probably the strongest bull market in history. Even then, they had 40% drops, 33. And then if my targets are hit down here, 58, 75. And so, again, Apple doesn't have to start losing money quarter after quarter to drop 50, 75%. You just have to have flows reverse, flows out of the market, money coming out of the market for whatever reason. And the big one is, I answered this recently. What could possibly put the brakes on this market? Somebody made mention about a black swan. That's the only thing that's going to stop the small caps from running or something like that. No, absolutely not. Consumer spending, that's it. A black swan can certainly put the brakes on the market. We saw that when COVID hit. But simply, if you go into a recession, a true bona fide economic contraction, a recession, especially if it's on the bigger side of recessions, then these stocks are going to go down, even if Apple's still profitable, even if Meta and Facebook. So again, the charts are the charts, and that's going to be a much more accurate predictor than trying to guess. Good luck with that. Again, if you're Warren Buffett and you can read a balance sheet and you can kind of look ahead 5-10 years, great. Use fundamental analysis. But I'll factor it in when applicable, or if I have a strong opinion. But what this site is about is technical analysis, and I just wanted to speak to that, to the fundamentals of how things can go. And interesting. Yesterday, Powell, he had his, if you guys remember Bernanke, the famous, no, it was Greenspan, the irrational exuberance comment, that came, back in the 90s, late 90s. Powell yesterday, came out and ventured to say that he thinks the market's overvalued. So that's kind of his moment. We'll see what the market does. Had a little hiccup yesterday. But all right, let's dive into the charts. Enough of that rambling stuff. Let's go to QQQ. Coming up on that target right here, about 529.50 right now. When I look at the futures, these again the charts I gave you. There was our breakdown, back test, and then yesterday's sell signal came from the break of the minor uptrend line, which formed this nice little wedge right here. And then I had noticed this morning you have this little potential head and shoulders, small one. I usually like to see head and shoulders on daily or weekly time frames, but this is just a 60-minute chart. But if you want to take it and kind of get an idea of where traders, because I know from doing this long enough that traders will take these head and shoulders and they'll fit them anywhere. They'll even use them as continuation patterns, although they're supposed to be topping patterns. But I've seen them used as such. And if enough people are looking at the same chart, taking the same targets, the way you do that is you take a line, you measure the distance for what I'm doing here from the head. Here, I'll make this fatter so you can see it. Make it nice and thick. From the head, top of the head down to the neckline, that's close enough. You add that to where it breaks down, that gives your measured target. So that would give us a measured target on that little head and shoulders right here. And there's some support there, about 24,554. There's the first target that I'd given you yesterday, 24,637. And we're coming up on that now, as well as that, where is it? That price target right there, about 592 and change on QQQ. All right, so again, that's it. And, I just want to reiterate that just as much as I'm open to anything, including a blow-off top, again, we'll let the charts be our guide. If and as each of these levels break, the way this works is, you get more and more what I call JCL, Johnny Come Lately longs. They didn't want to buy when we were covering on April 6th and going long at those lows. They might not have wanted to buy here, but they certainly want to buy lately. Get more and more of those. It's the retail crowd, we call it the dumb money, piling in lately. And so they start going underwater first, and their stops start getting hit. Then you have the next layers of support, like tranches, if you will, of stops. And, and that's it. So if it has each of these break, and it's this type of market, again, I'm not here to preach fear mongering, but, traded enough markets when you get this foaming at the mouth bullishness and this kind of belief from the masses, which I have gathered from what I've read and heard, folks on TV when I turn it on, that the market's just bulletproof and unstoppable. What happens, and I've monitored, and I've gone over this with you and showed you short interest ratios plummeting to 52-week lows on a lot of leading stocks and other things like that. Put to call ratios been pinning, coming off, historic low levels. There's just not a lot of fear in the market. I've told you the VIX is just, priced. There's a lot more upside potential than downside, in my opinion. But again, you got to get your timing right on the VIX. Now, as I said, trading the VIX is trading the stock market in reverse. So when you had the sell signal on QQQ, that was also a buy signal on VIX or VIXY, whatever you want to do. I like futures, but when they broke down, one was a breakdown on QQQ. Sorry, it was yesterday, right after the open. So, and that's VIXY going up now. That was yesterday. Right. Oh yeah, we broke out around the same time. The downtrend line, I give you on the VIX. So VIXY. So, and it's not really responding that much. Remember, the VIX also, as I always say, I like to focus on and trade the NASDAQ because it's a more concentrated weighting of the same top components of the S&P. S&P 500 is your grandma's index. It's got your utility stocks and healthcare, defensive issues, dividend-paying blue chips. And however, it also does have the same high flyers the NASDAQ does. And because of that, and it's also a cap-weighted index like the NASDAQ. So the utilities stocks and REITs can go to the moon and back, but it doesn't move the needle on the S&P 500. What moves the needle is tech, by far the largest sector, right? And so, again, they're going to go in the same direction. You're just going to get a multiple of the move by trading the NASDAQ 100. Same way you're going to, if you're bullish on gold, buy GDX, the gold mining stocks. They're going to go up more during an uptrend, and they're going to drop more during a downtrend. So same kind of principle there. Now, with that being said, there is a NASDAQ volatility index, but it doesn't have the liquidity on the options and the futures. So that's why I'll trade VIX futures. VXN is the NASDAQ volatility index, and that's what that chart looks like. I don't track it often. I just track the main VIX, but I'll just mark it up for you, just like the regular VIX that tracks the S&P 500, coming off a big divergent low. And you've been making higher lows despite the stock market making marginal new highs. We've had a series of higher lows there, and you have this potential trading range right here, and this is where VXN should let loose. And if that happens, it's probably because the market is breaking down those next support levels I gave you earlier in the video and recently. Okay, so an orderly pullback so far. Again, nothing at all earth-shattering, but the technicals are there. Breakdown, backtest, rollover. And so I don't have my daily chart fully marked up here. I need to mark right there. You had a previous all-time high there with a pullback, breakout, and a back test of it right there, on the breakdown there. So that's really on the daily chart, the next decent support that I see right there, about 580, 350. The things that I'm watching, again, I watch kind of a lot of obscure sectors of the market that most others aren't watching, and then you will, if this is going to be it, I don't know. I certainly, I've been on this for weeks now, even a couple months. These private credit companies and BIZD, I'm using this as kind of a tell. It's an ETF that invests in these BDC, business development companies, that do the private credit. And boom, we just hit that second target. So I started highlighting it to you back here, telling you that was, in my opinion, a very significant support level. If broken, was going to trigger a downtrend and tell us that there's maybe cracks in the system. You trade enough market cycles over as many decades as I have, it's always something. People always tend to look where the last thing broke. The housing market, that was 2008. Remember, 2007. And I know enough that cracks when you have excesses in the market, which are created by lax, excessive easy money policies, lax lending standards, and then more of this. This is where many have predicted where you might get the next big problem in the financial system. These shadow markets, private equity and private credit, the non-bank financials. Historically, you needed money, you were a business or an individual, went to a bank and you borrowed money, and everything was on the books. It was visible. Those loans had to be priced as to what they were worth give or take. Don't get me wrong. And go back to the financial crisis and Lehman and why everything else imploded, because the market isn't always efficient. But what happens is when certain sectors of like this implode, it's a vicious cycle. And so right now, I guarantee you, others are starting to take a look and saying, what's going on? Because the cut in interest rates was supposed to help this sector, should help this sector. And we're seeing it, continuing to sell off. And, watch some of the individual companies, that are making new lows or, free fall. And again, maybe not. Maybe these guys stabilize. Look, all I can tell you definitively right now, it's at support. It's at my second price target right now. Where did it go? Right, and which is where it should, and I'm using my little air quotes, quote unquote, should bounce, just like it did off this first target. We bounced, we went back to the former support, which support once broken becomes resistance. And it probably will bounce. But if it doesn't bounce, that kind of tells you, hey, something's going on here, and you're starting to see maybe a unwind in this space where maybe one or more companies blow up. And if one blows up, then what happens is, these loans are very liquid that they have. And if they need to meet, redemptions or liquidity, they have the liquidity issue, they have to sell. When you go to sell in a liquid asset in a market where there's hardly any buyers on the other side of it, you get a shitty price. And when that happens, then the other ones in the same sector, now, whether they do it or not, they should be repricing their loans, because that's now the current price, like it or not. It's just like a house in your neighborhood. If you're on Zillow, let's say you live on a little island, off the coast, and you're kind of in a bubble, you know what's going on the mainland, but then there's not a single house that's sold on your island for a year or 2 years. And so you think you're immune from a big drop, what's going on the mainland, or a big run up in prices, but all of a sudden a property sells next door to you, and then another one sells. Well, like it or not, that's the price of whatever your house is. No, obviously, comped out, number of bathrooms, bedrooms, year built, square footage, and all that, and then they get a square foot price. But and again, you're going to say, and that's how the real estate market works. Nobody ever wants. They look at their Z estimate, and their house is worth 1.3, whatever the number is, and they'll be damned if that's what they're going to take anything less for. Then they go to finally list. They think it's time to sell. They're going to list at 1.3. It's not moving, it's not moving, it's not moving, it's not moving. They don't drop, they don't drop, they hold that price. But then finally, two houses nearby them sell, comparable houses, and they sell for 800,000. They realize, okay, I got to move their price down. They start chasing the market down, and 800 is really what their house is worth. Nobody's going to pay 1.3 when two houses in the same block just sold comparable houses for 800,000. So I just want you to understand that's how these things work. And again, this thing could rally up. Maybe it's a buying opportunity and we go up. And if it does, then hey, guess what? It's going to drop off my radar. I'm not going to cover it as much as a thing to watch. If we go up here and we take back that 1574 level, we're also going to take back this downtrend line. And that's bullish, right? And then guess what? At least at this point in time up here, I'll still keep this thing on my radar, but I'm not going to say it's a yellow flag for the market. Right now, it is a yellow flag. That's all. And the one that I really want to see, again, to increase the odds that the market is near a top or has already topped, watch credit spreads. And again, you can pull them up. I have charts from the various Federal Reserve banks of credit spreads. The simple way is just to look at junk bonds. HYG and JNK are your two big junk bond ETFs. And you can see I have trend lines. Both of them are above. There's HYG, there's JNK. And right now they're doing well. That JNK just broke down, however, just broke this uptrend line. This isn't a big move. If I start seeing this drop, especially relative to treasuries, because that's what credit spreads are, the differential between high yielding, ultra safe government treasury bonds and those higher risk junk bonds. And that's the one and probably final shoe to drop. So I'll watch that. This is TLT, as I mentioned. We had a little short trade here, short there, divergent high, hit the price target right there. You had nice support there. There was a gap right there. We just right in there on the bottom of that gap, and bounced as expected. However, yesterday was the first green day. And again, it was an expected bounce off the initial tag of support. The first green day since the Fed cut rates. So far, the pattern, again, as I said yesterday, 1 week doesn't make a trend. It's the start of a trend. But now, basically, if we take out on TLT, I'm back to the daily chart. This is the level right here. It's boom, reaction. Most important, 1, 2, 3, these recent reactions. 88, 50-ish, give or take. Bottom line, if we clearly take out the recent lows, that's going to be a technical breakdown and a bearish event for treasury bonds. Going down, meaning yields are going up. And now, so if to help support a rally in the stock market, you want to see treasuries rally from here. And the only caveat or asterisk is you don't want to see this happening because the stock market is going down and moving down impulsively. Taking out those support levels I told you about, because that'll be a flight to safety bid. And so other than that, if we can organically, remember the Fed cut rates, if you see TLT go up, it's because long-term rates are falling, and that's going to help mortgages and car loans and business loans and commercial real estate and all that good stuff. But if this happens, then you're going to see a repeat of what happened last time. And the market didn't freak out right away. The last Fed cutting cycle, as I told you, it took a little while, and this is where the market peaked after it was right here after we had that first correction. Remember, this is the yield on the treasury bonds. So bonds were going down, yields went up, and then this is when the stock market peaked. And it leveled out, and then the correction started right here once it took out that previous low. And so after 3 cuts, rates went nowhere but up. Again, if that pattern... Now, one thing I want to tell you, too, is this is where the Fed started cutting rates a year ago. This is where the long bond was. The 30-year was down at about a 3.93 yield right there, right? So that was our starting point from the last rate cutting cycle. Guess what? This right here at about a 4.6, 4.7% yield is where we started out. So you'd have to fall quite a bit just to get back to where we started there. So yields, my point is, yields are already elevated. So there's not a lot of wiggle room this time around for yields to go up. Because if they take that out, then they have, as I've told you many times over, they've now broken out to multi-year and even multi-decade highs that could take the long bond, the 30-year bond, back to yields not seen since the 90s. And that would be just insanely bearish for the stock market. And again, it's not as much as a prediction as something to watch for. Now this, again, if it's organic abatement in yields where yields fall because there's no inflation or the bond vigilantes don't step in again this time around, then that would help support that scenario that's many are calling for. New highs in the stock market, a continued, rally into year end and into 2026. All right, enough on that. So just watch that. And again, you can watch the credit bond. You can pull up any chart of credit spreads or just watch JNK and HYG, the junk bond ETFs, because they still are holding up. They're not pricing in any duress in the credit markets. And again, I'm seeing, the private credit is showing me something's going on. And remember, private equity, they're intertwined in there. A lot of those same companies are dipping their hand in the same cooking jar. It's the opposite term, if you will. Equity is ownership, credit is debt. They're doing loans, but many of these same companies, and you can see, so the markets are saying, hey, all right, something might be going on here. And maybe it's a sell first, ask questions later, or maybe those little birdies, those in the know something's going on and know it's time to get out of private equity. Because fundamentally, why isn't private equity doing this with all that talk about opening up 401ks, which is just a ginormous market? That would be like private equity firms winning all the lotteries and Powerballs combined. But so what's going on here? Private equity's peaking out so far. Tried to make new highs like the stock market, but so far rejected, and pretty impulsive selling today. So again, not mere coincidence. So believe me, I watch PSP, the private equity ETF portfolio. It's got the likes of Blackstone. You can see my charts. You can see the levels. KKR, that was also a divergent high right there. You had roughly equal highs and prices right there with lower highs in the indicators. And that's it. Let me see if any stand out. I'm kind of doing this in real time here. I didn't pull these charts before I started the video. Look at that Carlyle Group. All right. I mean, again, that's a technical breakdown. I've had this trend line here. It's nice and clean. Created that trend line back a few days ago because I'm watching this sector closely. Look at that. Comes off the lows. Boom. Breakdown. That's a sell signal. And that's going to be hard to undo by the close today. So I don't think that's going to prove to be I don't think we're going to get a stick save. We'd have to rally up, or CG would, about, just to get back on the trend line, it's going to have to rally up about 5%. So that's it. So keep an eye on it. And what I do, I look at the sector. I go through these all the time. That's what I'm doing all day. And Halliburton, that's really oil and gas. It's showing in this ETF. ARCC. All right, so there's what they look like. I got a lot of them, telling me the same thing. Those that are at highs have divergence, negative divergence. Most of them are overbought. And others are starting to crack. There's MIN, Main Street Capital. I already broke both trend lines that I had 3 trend lines all taken out. Little head and shoulders pattern action going on there too. This is a neckline right there of a head and shoulders pattern. I don't always label. I can see this. I just look at the chart. I see the pattern. That's a left shoulder right there. Head. It's a nice symmetrical pattern too. Right shoulder. And we just broke the neckline. So that one, to give a measured target, as I showed you earlier in the video, take the distance from the highest point in the head down to the neckline, the shortest distance. So you put a little angled line because you have upward sloping neckline. Add that to where the pattern breaks down, and that's going to come in right above my 60, 18-ish target there. You also have the 200-day moving averages. Okay, something else that I monitor, cover from time to time, is this chart. This is FINRA. It used to be the NYSE margin debt. Now they call it FINRA. They stopped. They shifted over to FINRA margin debt. So basically, this is, you can get a description. You go any of these. Well, some of the websites will give it to you, but basic info, here it is. You can read up on it. The debt balance and a margin account is money owed by the customer to the broker advance. So what happens? Okay, guys. So what happens in bull markets is when as prices go higher and higher, more and more people become bullish, and they start to say to themselves, they have this conversation in their head that, oh man, I'm making so much money on NVIDIA, it just keeps going up. I'm making insane money. I put in, I had 50,000 in the account. Now I have 300, and it's going up every day. I'm making 20, 30,000 a day. Why don't I do a margin loan, start a margin account, and leverage up and buy 600,000 of NVIDIA? My broker will let me, or whatever. And so that's one way. And traders tend to get margined up towards the end of a bull market. That's why, if you ever wonder why bear markets are so swift and relentless on the downside, and wipe out the real bear markets, it's because these bubbles. And this is old as the hills right here, guys. The market starts going up, and then towards the end, it goes parabolic. These shaded lines are recessions, because this was a dot-com bubble burst. Most of the drop didn't affect the economy as bad, because it was a tech bubble. It was a bubble in the dot-com stocks, and the Nasdaq fell almost 80%, but the S&P didn't fall that much, nearly. But it did lead to, because of that wealth effect thing. So again, this is kind of where, again, if you have a hard time grasping how aggressive my longer term targets are, and again, they're based largely on the charts, but the fundamentals go in because it's a vicious cycle. The same wealth effect that has caused NVIDIA and Microsoft and Apple and all these stocks to go to where they are now, $3, even $4 trillion companies. It's a vicious cycle of the stock market going up. You have your portfolio is going up, your 401k, you feel better, you're going to spend more money, and most people have jobs. Housing market's going up. Those are the two biggest components of wealth for the haves in this world. Unfortunately, we have the haves and the haves not. So as you all heard about many times over, the Fed is just destroying. It's the Fed single-handedly, or majority of the Fed, that is just causing this huge wealth gap that you're hearing about, where the have-nots, because they don't own a house, they rent. They don't have a 401k. They live paycheck to paycheck. And so this inflation is killing them. They're getting poorer. The rich are getting richer. And that's because the Fed keeps backstopping every correction every time the economy hiccups, instead of letting things just run their course. But where I'm going is, you could see, after in a bear market, so what happens is the debt bubble, the margin bubble, gets unwound. Margin calls, when you have everybody loaded up on margin. Then when the tide finally turns, and you get starts out with a correction, then that's a 10% drop, the old antiquated definition. Then a bear market, 20% drop. And the lower you go, more and more people, whether they want or not, they can love their NVIDIA. You can put a gun to their head and they say, I'm not selling my NVIDIA. I don't want to sell it. But guess what? If you load it up on NVIDIA in a margin account, you have no choice, because either you get that margin call when it starts dropping, either you sell it or your broker will blow you out. You know that. And that's called a margin call. They're going to force sell you out of it. And so that's why in every bear market you have these big drops. That's why the Nasdaq dropped 80% after the dot-com bubble popped. And the same thing happened. And you can see the trend. So there's always an increase, right, during a bull market, which is natural and logical. Prices are going up more. But it's towards that end, you can see that last parabolic run up where just everybody gets giddy, and they have that feeling that the stock market's going to go up forever, because Kramer said it's just, there's all these reasons the market's going to go up, or whatever analyst de jour. And then it just stops, and it's because it got too top heavy. And again, valuations got ahead of themselves. You can put a line through here. This is the mean here. So you get these mean reversions. And so, this was COVID right here, this recession. and the big bear market, the 36% drop in the S&P. But you can see you get that final surge and then the unwinding. There was a huge surge after COVID. Why? This was unprecedented because not just the Fed, not just the federal government, but every central bank and every sovereign government in the world flooded the world with liquidity and stimulus. And so you saw this ginormous surge up in margin debt. Then that drop in 2022, bear market, whatever you want to call it, we shorted down, covered the lows. That was due to the unwinding of that margin bubble. And look what's happened. We've gone just parabolic again. So if you're wondering what are some of the catalysts, because you just can't understand it, right? You keep talking about this, and on TV they keep telling you the economy is on stable footing. Yeah, the job market's softening a little bit, but the Fed's here now. They're cutting rates, so that's going to fix that. Look, I already showed you the job market. There's no variance. It just like this chart, when it troughs, when it bottoms, it V's. It's just pretty much no variance after the big drops. That's what it looks like. And the job market does the same thing, and the job market's already turned. And so now, over the next year, if I'm correct, and we see unemployment continue to rise, it's going to begin to accelerate. Then you're going to see money come out of stocks for that reason. AI, so far, we're seeing that. I'm going to get to another chart here in a second. I've covered it 100 times. Stock percentage of stocks above their 200-day moving averages. The stock market's kind of not, if you strip it out, it's really AI that's really in the great bull market. And but that will ultimately happen when the turn comes. You're going to see the money coming out, the margin bubble unwinding, this popping. And again, it then is a vicious cycle because selling begets more selling. It's a very, very simple concept to follow. Now, when's it going to happen? Well, I had indicators. We broke some long-term things last year. I thought that might be the top. That's why I laid out those 7 long-term targets on the S&P and NASDAQ 100 I keep sharing with you. And we've already hit 3 of them. We're just up that marginal new high. And then the next drop down is going to be pretty hard and swift. And this is going to accelerate. Again, I'm trying to give you in a very simplistic view of how that can happen and why that can happen. I do look at other things, by the way. I go down here. I'm going to play devil's advocate here, okay? And I'm going to do that because it's the right thing to do as to why maybe we could see a blow off top and why this chart might not be as bearish as it looks. These are the net numbers. But when you look at the margin debt relative to the market, let's see, where you have FINRA margin debt relative to GDP. Here it is, to total market cap. It looks a little bit different. Obviously, it looks quite a bit different. And so it's showing that it's relatively low. And maybe that supports it. Now, I think you have quirky things going on in the market, especially with the unbalancing of NVIDIA and other things out there. So I'm looking at the raw numbers because that's what I've always looked at. But I just wanted to point this out to you, that it shows relative to the total market cap. And I think they're using the S&P 500 or Wilshire here. I've seen this chart where they use the S&P. It's similar. We're relatively low again on there, especially, but we're also about where we were, not too far off it when the dot-com bubble popped. That was right here. We got a little higher after that, but it was right here. I'm sorry, it would have been right there. So we're a little bit higher there. We were about 2% right there. We were up at this 2% number again compared to the total stock market. But this is the one that I'm going off of. These are the absolute numbers. And I put a little bit heavier weighting on this. And the other things I cover for you from time to time are things such as my various sentiment indicators, put to call ratios, one of the best ones, especially the equity only, AAII bull to bear spread, which this up top just shows you the differential, the spread. So that's a weekly survey from the American Association of Individual Investors. Hey, are you bullish or are you bearish? What's your near-term outlook for the market? It's what I call a rhetoric indicator. I call the put to call ratio a money where your mouth is indicator, because that's people. You buy a put or call, you're putting your money where your mouth is. You're betting a stock's going to go up or down. I know there's hedging involved too, but you'll see the extremes is everybody, when the put to call ratio goes to extremes, it's everybody buying either a whole lot more puts than calls or a whole lot more calls than puts. And it's a contrary indicator. This is, again, a rhetoric indicator because you can say that you're bullish and you plan to buy, but you don't have to buy a stock. You may change your mind. That's why I call it a rhetoric indicator. But it's been used for years. And this is, I've shared this chart with you for many, many years. And this is where I have a red zone. This is where you want to be buying stocks. This is when everyone's, selling. This is when everyone gets bullish. That's why it's a red zone. And it's not a one or done. It's usually extreme. So you had extreme bullishness up to this point. Then the market finally peaked. And then you had extreme bearishness right here, right? And so as I pointed out before, when you look back to the last real bear market, the one that kind of played out like a market should, as I've said, the Fed has come in, starting with COVID, really since the end or during that bear market is where they started to get kind of bold with their easy money policies, quantitative easing, zero interest rate policies. And then when COVID hit, they hit the all-out nuclear button, just went crazy printing money, and the federal government sending everybody stimulus, bailing people out, even if they didn't need it. Businesses getting money shoved down their throat, having their best year ever, and getting tons of money through the payroll protection program, all that kind of good stuff. But you can see back here, my mistake is, and if I change it, I got to redo all the annotations. I didn't do it log scaling. So when you're looking at this, keep in mind, this is linear. This drop right here, this was the financial crisis. They call it the Great Recession. It was a over 55% drop in both the S&P and the NASDAQ. But it looks like a little blip, like a little correction. To put it in perspective, right here, we went from about that drop that we had in 2022. We were over 6,000 on the S&P, and we dropped down to 5,000. If we dropped in half, it would take us from 6,000 down to 3,000. And this is what it would look like. Again, I can fix that by doing log scaling. Someday I will. I just wanted to point out that over time, when you're on linear scaling like this is, it makes these moves. It kind of puts them out of, they're not proportionate to the percentage drops because it's in absolute dollar terms. Hopefully you understand that. All right, but what I wanted to show you is back here, and I pointed this out in the past. So when the market peaked right here, this was the end of the bull market in October of 07. That's when the market peaked. And folks started getting bearish. And we hit this extreme, my green zone, which is where you want to buy. And we hit that right, and we stayed bearish. Again, the red is everybody getting bearish. Up until this was the midpoint, our first good bear market rally right there in April. And you can see everybody got bullish because the market was rallying. And this went positive again. Right after it crossed down, that bear market rally had run its course, and then the biggest drop followed. Similar to here, we had a peak right here. We went up. That's a hell of a rally, I'll give it that, if that's what it is. Everybody got bullish for a while, but we've crossed back down there. I just want to note that similarity there. The other one I really like, even better than this, like I said, this is an indicator. It's kind of, again, it's a rhetoric indicator. You can say you're bearish, but you don't necessarily, doesn't mean you're sold, or maybe you plan to sell, but you didn't sell, something changed your mind. That's why I put a higher weighting on the put to call ratio. This is the weekly CPCE, the equity only. And again, you get these clusters, like you said, excessive. You get a cluster of bearish readings followed by a tag there, and we hit it again. Remember, when you're coming after a bear market or big correction, ignore the extreme bearishness. It's usually you get down. You can see here I have this level here. This is the 100 period moving average. I like to put this on because this shows you that there's so much, this can be such an erratic chart. You can have a big week, big headline, all of a sudden the put to call ratio spikes. So it's smooth out. Anytime you put a moving average on something, it smooths out. And you can see we hit that line, and then shortly after the bear market came, you touched it again there, and you had a 22% drop right here in the S&P. You hit it again there a couple times, and this was a sideways market with two corrections that were almost 20%. It took about a year and a half, the stock market going nowhere with two big drops in there. Again, when we got really low there. We hit it right there. Boom. That was right after COVID. We hit it there, but then you had this drop. And it was quite a bit of a lag. I'm going to point that out. But I just wanted to say recently, as I highlighted back then, we've crossed that level here. And all we've had is a hiccup so far. And again, we hit it here and it took a while. It took almost a year probably right there. So there's a little bit of a lag. All that it shows you, if you kind of look, guys, just bigger picture, this is when everybody's getting bearish. You want to be buying the stock market here in the green zone. That means buy these points. This is where everyone's bullish. Put to call ratio is very low. Everybody's bullish. So we're coming off this period just like here of extreme lows, and we're not far from that level again, but we've already had multiple tags right there. So again, what it's showing you, what I've been saying, no fear. Now, okay, that's a sentiment indicator. Look at one more. I think I'll wrap it up. I'm going to just take a look, see if there's anything else I wanted to cover, but let me show you one more chart. Okay, a few weeks back, I did a whole video dedicated to breadth and or sentiment indicators. I think it was mostly breadth indicators. I'm only going to go over this one now. There's a lot out there. They're mostly singing the same tune. And this is the up top, you have QQQ, and I do have it on log scaling. You can see this is what log scaling looks like. So everything's in nice percentage terms. You can see all the corrections. Yeah, you probably can't. That's 25%, 18, 5, 30, almost 38, 26 recently right there. And what this is down here, you have two things. You have the percentage of stocks trading above their 50-day moving average. And down below right here on this chart, you have the percentage of stocks trading above their 200-day moving average. Okay. So you're at a stock market which is fresh off new all-time highs, yet what's going on here? This is the 50 level. Remember, these ranges are bounded by 0 and 100. You can never have more than 100% of your stock, any stocks in a certain subset. In this case, it's stocks in the NASDAQ trading above their 100-day or 50-day or any moving average, or you can never have 0. So you're never going to get all the way to 100 or 0. And so 50 is the midpoint. So what this is telling us is, since really back here at that peak back in 2021, before that big drop in 2022, we have not been able to exceed that 50% level. We're still there right now. Again, the percentage of stocks. So this is what I've been telling you. I'm not the only one that recognizes this, but this is not a healthy stock market. It is if your money is all in AI and tech stocks that are causing this this big move up. I'm just updating my chart, guys. Sorry, I haven't updated in a little bit, and it's just in my nature when I look at these lines to continue to update them, move them forward. So this is the most recent high, and you can see the divergence here. Let me save it. Save that. I need to recenter it for you. Okay, so that's it. So the stock market continues to go higher, as it did here. These are divergence lines. That's what you're looking at. So they're divergences in a healthy rally. And this is a healthy rally right here. We put in a divergent low. You want to see more and more stocks. You want to see them going above the 50% level. You want to see, obviously, more stocks trading above their 50 and especially their 200-day moving average. That's what you saw here. It's what you saw coming out of the gates after the 2009, the 07 to 09 bull market was over. I haven't gone back this far here. I just want to point out we continue to diverge. So this keeps making lower lows. So does the percent above their 50-day moving average. This is negative divergence. With the market going up, it shows you that, yes, the indexes are going up, but those are the cap-weighted indexes due to, again, the effect of that circle jerk between Microsoft and Alphabet spending a ton of CapEx spending on that's benefiting NVIDIA for this AI thing. And again, when it goes the other way, if it does, and who knows, maybe we're looking at 10 years of just some mega crazy stock market thing that I and others can't even imagine. I don't think that's the case. This time it's different. Again, who was it? John Templeton? I believe Sir John Templeton said those are the four most dangerous words in investing. This time it's different. So we'll see. However, this is not a subjective read. This is a hard read telling you right here that with the stock market making new highs, the majority of stocks are still half of them above their 200s in the NASDAQ and half are below right now. And same thing, a little bit more on the 50 right there. This is an end of day chart. It won't be updated. It'll drop down today, obviously, because we're down. Oh, okay. Yeah, one more thing I wanted to cover with you. You know, I'm talking about gold, GDX, and saying, you know, gave you my view on the dollar and my view on gold and GDX is saying until the dollar, you know, starts going up. The dollar did break out today. We have it. Remember this last update I gave you, last couple updates was this downtrend line. So to go back, if you're new to the site, coming back here, point out UUP, which is the ETF for the, or ETN technically for the dollar index, has long-term support in this trading range. We came down here and we had positive divergence. And so we went up and we broke out of this bullish falling wedge. We hit that first target. We pulled back and we saw a drift down in the dollar due to the the last week's Fed meeting, as it became more and more certain based on the federal fund futures that we're going to get a rate cut, at least a quarter point, maybe even 50 basis points. The dollar fell, but guess, as I said, it still held support. You would think that the dollar would be down here. And now it's broken out. So this is a near-term bullish technical event. The dollar has broken out. Now I can tell you right now, I'm going to add a level. If you want to track UUP, right here, I see resistance about 27.62. If that's taken out, and again, this is my preferred scenario, that'll take it up here. And again, this is an incremental thing. I believe that if and as I'm correct and we continue to move up towards T2, more and more gold bugs, gold investors in gold, silver and GDX are going to get the memo, and that's going to be net bearish for gold and silver. And so today, call it mere coincidence, there's a breakout, a pretty decent move, 0.73 in the dollar. I'm going to show you Euro, US, and the Euro is the biggest component in the dollar index. So we're close, but not there yet. Look at this uptrend line. Nice clean uptrend line. See that? Those two lines I just drew. We had a divergent high here in the euro. This is the euro against the dollar. So when this goes down, the dollar is going up, and that's bearish for gold. We had a divergent high there, and we got a correction off that divergent high. Just like the stock market, we pushed up, made a marginal new, but still divergent high, and it only extended the same divergence lines that were there before. You can see them down here more clearly. I have them a little squished, but you can see we have clear negative divergence on the euro, which tells me that this is a trend line where you could certainly step in and buy it if you're bullish and you're a trader of the euro. That's pull back to support. That's TA 101, right? You buy a pull back to support. However, based on the posture of this chart, it's a support level I'd rather not buy because I'm betting it's going to break sooner or later based on the divergence and the technical posture here. And then if that happens, that's going to be the catalyst for a drop in the euro, a rally in the dollar. It's going to bring the dollar higher, and guess what happens? So today is nice up day in the dollar, and not mere coincidence, the gold's down. Now gold's flirting with this uptrend line I gave you on the daily chart. This is what it looks like on the 60. We already broke the minor trend line. This is, again, in my opinion, not coincidence that the dollar is up, gold's down. Takes out that trend line, it's going to go there, and longer term, I could see it coming back and testing the top of that trading range. And then, like I said, you can go long and short gold or just magnify your gains. It's like trading gold on leverage. You can just simply trade GDX, just move the lines like football. You get a first down, they pick up the first down markers. That's what I did with the divergence lines. I just move them, made a new and bigger divergent high, and now GDX is down 2.41. This is a hot air trade right here, a lot of hot air. So silver, do I have it marked up? I like futures. Yeah, same thing, divergent high right there, break of that little trend line. Let me show you silver futures. This is what it looks like here on my 60-minute chart. A little divergent high there, a little minor uptrend line that's broken. It's kind of an iffy level there. Bottom line, this is where we'll probably come back to a minimum right there. That's, if so, that's going to be represent a drop from the recent high of about 8% on silver. And again, it's not 100%, but largely contingent on the dollar continuing to rally. In other words, it's going to increase the odds. And if that level is taken out, well, here's an uptrend line and a next potential target down around here. Okay, another long video, but I kind of went all over the place, talked fundamentals, talked sentiment indicators and breadth indicators, and even got into gold and silver and the dollar there at the end. So, all right, let's see where we go. Like I said, the markets remain on sell signals, how far down they go. So I've given you, my arrows show you where I think it's likely, but in those, where is it? It's contingent on each one breaking the next level. So you go to for example, the NASDAQ futures. This is our first support where a reaction is likely, 24,637. And then if and when that's broken, you can see 24,287. So where we that was this morning's chart, 24,637. Let's move that. Oops, that's not what I meant to move. That was it. I was trying to move. I hate this charting platform when it comes to things like this. I can't grab. There it is. I can grab that trend line. What did I just say? 24,637. Yes, 24,637. I got to put the line back where I had it. That's where I give it to you this morning. And that's it. So boom, you would cover. There's a reaction. However, there's a lot higher in this market. So my preference is to sit tight for at least this level. Yeah, we already had a little reaction there. What I mean by that, you can look at a 1 minute chart and see there's the reaction, 24,637, which is right there. So I was we overshot it by 0.4% roughly. That's literally basis points. That's a near perfect hit of that level. That's how this stuff works. And now we go through there. We take out today's lows. That will be that first target / support I gave you. Opens the door to the next one. And again, this is the one before all said and done at bare minimum, I think we'll likely hit coming up. And if and when that's taken out, you have all the other ones there. And this is kind of a much bigger deal down here. All right, I'm going to wrap it up, get the video out to you guys. We'll see where we close the day. And if anything big happens, I'll do another video or update by the end of the day. If not, we'll just pick it up tomorrow. This has been Randy Finney with Right Side of the Chart. Have a great day.